Thank you for checking out Real Talk Personal Finance. Shit's about to get real. Cashflow King with you today, and today in episode 20, the 4% rule. Now, you probably clicked on the title of today's show for one of two reasons. Number one, curiosity is a bitch and you have no clue what the 4% rule is, but you want to know. Or number two, you already know what the 4% rule is, and maybe you've listened to other podcasts on it in the past, and you are just looking for either a refresher or perhaps a new perspective. So in either case, you've come to the right place. Before we get into today's show, episode 20 on the 4% rule, just want to do a quick shout out, which I haven't done last show, maybe even the past couple of shows, because we haven't had a ton of new listeners, just some repeat locations. But it looks like we have a little bit of a spike up in Austin, Texas. So shout out to our new listeners in Austin, Texas. We appreciate you, and we appreciate all our listeners that are tuning into Real Talk Personal Finance. So really shout out to everybody, but specifically we got some new folks out in Austin, Texas. So thanks for tuning into the show. If you feel like we've earned it, as always, please feel free to consider leaving a 5-star review and or rating. That would greatly help out the show. Also, feel free to share it with your friends, family members, coworkers that aren't sensitive to a little bit of vulgarity, and so on and so forth. Whomever you'd like to share the show with, we certainly appreciate the share. So what is today's show all about? Well, this episode is about a popular historical guideline for sustainable retirement distributions. And in a few minutes, we'll talk about what that means in English. But for now, really quick, a history lesson, a brief history lesson. And I will also say that I will mention a few individuals throughout today's show. Normally, I don't like to mention people or companies specifically unless it's Costco and their chicken bakes and how somehow they're still selling them for a very, very reasonable price that has not seemed to go up, at least as of yet. We're recording this at the end of June 2022 due to inflation, unlike everything else around us. But other than a couple of shout outs here and there, I normally don't like to shout out different people or companies or anything specifically, even other podcasts. But I can't really do today's show without giving kudos and credit to a few individuals. So they will be mentioned as the show goes on. So with that said, and buckle up, for those that are like me that aren't really big history buffs, don't worry, this is going to be quick, but we got to do it. First, a quick history lesson regarding the 4% rule. So back in 1994, there was a gentleman named William Bengen, goes by Bill Bengen, and he was a former aerospace engineer turned financial advisor. He wrote an article on sustainable retirement distributions, and you might be thinking, well, is this stuff really rocket science? Short answer is no, not really. A lot of practitioners in the space, such as myself and some others, probably make this stuff out to be more complicated than it actually is. At least in my case, it's not to be a jackass, but more so because there really is a lot of nuance to this, and decisions that need to be made are really truly individualized decisions. And there's a lot of considerations, as we'll talk about throughout today's show, that need to be factored in. So it's not a real quick, easy, simple, this is the answer in absolute terms. But yet we can use this, as we'll talk about, as a guideline and looking at some other things to ultimately make a more cohesive and comprehensive decision. So anyway, in 94, Bill Bengen wrote this article. A few years later, in 1998, there was a study that came out called the Trinity Study that pretty much came to substantially the same conclusion and solidified Bill's research. And there were some people out there that were kind of hating on some of the research that he did, and others that were big proponents and supporters of it. And in some way, shape, or form, as we'll talk about as the show goes on, there's a lot of discussions, even still, how this may or may not hold true today. And again, we'll discuss that in detail as the show goes on. But what the hell are we talking about? Well, what's it all about? Let's just say, and as the study did, assume that somebody goes to retire at age 65, so mid-60s, that they are going to live approximately 30 years in retirement. So they're going to live through into age 95. And they have sort of your textbook moderate portfolio, which is basically 60% equities or stocks. And in the case of the original study, specifically U.S. large cap stocks, and 40% bonds or fixed income. In the case of the original study, specifically 40% U.S. intermediate bonds. We'll assume that that's their portfolio. And essentially the question was, how much can we withdraw from this portfolio, adjust it every year for inflation, and not run out of money, right? How much can we take out? And of course, the results are going to be varied, right? Depending on market conditions and all that. But what is the amount that if we took that out under the worst scenario, right? Even in the worst historical market conditions, would that number have been quote unquote safe and we wouldn't have run out of money? And the answer came out to be just north of 4%. And then basically the 4% rule was born. That's it. That's our history lesson, right? I guess I could just do a quick 6-minute or so podcast and be done. But that, in essence, is what we're talking about. So let's kind of put this in perspective. Let's dig a little bit deeper, maybe put some numbers to it, and see if we can make sense of this whole thing. And then I'll make some comments as we go along throughout the rest of the show today in terms of what my thoughts are and what some people are doing today and how practitioners are using or not using this rule today and how everything fits together. That's pretty much going to be the majority of the show. What does this actually mean? And so when I think about that and when that question is posed, I guess let's try to answer this kind of like I did when I was on vacation a few years ago in Mexico. We were in an all-inclusive resort. There was a gentleman and his wife was there with him. We were all kind of sitting at the bar, and we'll just refer to them as the Akumal couple. They were very, very big fans of a specific resort in Akumal. That's not where we were at the time, but that's one resort that they always talked about. Anyway, he was mid-40s, and he had mentioned over a few drinks that he had kind of fallen behind on his retirement savings, and hopefully he's not listening to the show, but probably because of all of his fucking trucks and some timeshare bullshit that they had fallen into that he was telling me about. I think he said at the time they were kind of all in for about $50,000 into some timeshare program at one of these resorts and all this kind of stuff. Anyway, didn't necessarily seem like, and I hate to say this, but that he was the sharpest tool in the shed when it came to personal finance. And so we were talking and he was kind of, asking different questions, telling me a little bit about his situation. And he pretty much wanted a back of the napkin answer on pretty much like, how much do we need? And he just couldn't seem to let that go. And I tried to explain to him, well, there's some nuance to this and there's different considerations. And he didn't want to hear any of that shit. He just wanted a number, right? And needless to say, he was probably at least a little bit intoxicated. And so finally, I just turned around and I asked him, I said, all right, well, how much do you guys spend each month? And he said about $6,000. They didn't have kids at the time. So I pulled up a calculator on my phone and I took $6,000, multiplied by 12 months, got $72,000 a year. Took that $72,000 and divided by 0.04 for the 4% rule. And it came out to $1.8 million. And I just took my phone and I showed him my screen. And I just looked at him. And his mouth dropped. And then the conversation continued. What he wanted was a, let's hit the easy button, quick answer. What's the number that I need in order for us to quote unquote retire? Absent of any other information. Sometimes people just want the quick answer, and it may or may not be the most accurate answer, but there was really no getting through to this guy at this point in the conversation. So I just kind of obliged and, crunched some numbers, showed it to him. And then after that, after I had his attention, tried to explain to him that, there's a little bit more to it than that, but pretty much that's what you wanted to know. Because it's like he didn't want to hear anything else until he had a number. So at quick glance, that was the number. So if you took your expenses and you divide by 0.04 for the 4% rule, or pretty much the inverse of that, the other way to do it is just to take your annual expenses and multiply by 25. So if I took the same $72,000 a year that they were spending and multiplied that by 25, I would come out with the same $1.8 million. And that will give you a ballpark number. Again, this should give you a general guideline, and it warrants many other considerations, but it's a good starting point. So you might be wondering, well, do practitioners in the field, the financial advisors, actually use 4%? And the short answer is that some do and some don't. It depends on the practitioner and also their overall approach to retirement income planning. There's another gentleman in the space who's done a significant amount of research on this. He's also been on podcasts talking about this, named Michael Kitces, and he's mentioned in the past that he's used anywhere from 4.5% to 5% distribution rates with clients. Bill Bengen, the sort of father of or creator of, if you will, the 4% rule, is said to have used about 4.5%. in terms of a distribution rate, but this was several years after the original study while he was still practicing. And at the time, this actually included when he was using small cap stocks with clients. So the initial study does not assume that there was any exposure to small cap, but years later, there's been several different revisions. In the interest of time, we're not going to go through really any of that today, but it's been tweaked over time, and the distribution rates in a lot of cases have been shown to, at least historically speaking, be able to be a little bit higher than that initial 4%. So again, he's said to have used 4.5%, once including some other asset classes, whether it be international, in this particular case, small cap stocks. So he was around 4.5%. Again, the important consideration, there's a lot of them, but one of them in particular, if you're using sort of this probabilistic approach to retirement income planning, or this 4% rule. When I say probabilistic, I kind of jokingly say because that means that things will probably be okay. There is no 100% bulletproof guarantee that this is going to work in any and all market conditions. But again, history has a tendency to repeat itself. And so if we look back over history, we can see that even during some of the worst of times, that the 4% rule has proven to be pretty solid. But if you're using this, especially for basic living expenses, you have to have an ability and a willingness to use guardrails, which we'll talk about here shortly. The problem is, or the challenge is, that you may not be able to do what we'll describe here shortly, the guardrails type of approach, with basic living expenses. I can't tell you to potentially reduce your spending on, for example, groceries, just because your portfolio is not performing well in light of market conditions, and perhaps you started out with an initial distribution rate that was a little bit too large, that you need to ratchet that down. Especially, for example, even in times like this, but in any time at all, groceries and having food on the table, or utility bills, or things along those lines, those are really non-negotiables. There's really no, you can make an argument about, well, instead of shopping at fucking Whole Foods, buy your shit at Aldi or whatever. Okay, fine. But the vast majority of people in most situations are not going to be able to take a significant cut back in their expenditures for basic living expenses. So you do want to be careful. If you're using the 4% rule as part of your planning, one of the things you might consider doing is breaking up your expenses into several categories, but two big ones, and that would be number one, basic and essential living expenses, and then number two, more discretionary and flexible types of expenses. And you may not want to use the 4% rule for your basic living expenses. You can make an argument that you could do that potentially, but there is a little bit more risk, I guess you could say, with doing it that way. And so when I look at this as a practitioner, one reason that I would prefer with my clients to use the 4% rule approach with more discretionary expenses instead is for the reasons that I already mentioned, and essentially the fact that those discretionary expenses, as the name specifically states, they're discretionary, right? They're not essential. And so they potentially can be cut back on, whereas essential expenses can't be. And so you just really want to be careful and at least have really thought through that before making that ultimate decision. Let's talk now a little bit about the guardrails approach. And this was a gentleman that came up with, and there's all different practitioners that use this, but there's one in particular who has a very specific way of doing this, which I think is pretty interesting. His name's Jonathan Guyton. And he has sort of a ratcheting approach to spending in light of the 4% rule. It's basically a 4% type of rule with some modifications. And before we get into specifically what those are, let's first talk about an example. So back in the day, when I was a kid, I remember getting a trophy at this. I was at a bowling league at one time, and I got a trophy for, I'll never forget, it was second highest triple in Class A. And to this day, I still have no clue what the hell that means, right? But they gave it out, and it was this sort of, award among many other awards that were given out. I don't think it was quite like a perfect attendance award like a lot of kids seem to get today. Like, hey, thanks for showing up. Here's a fucking cookie, right? That's a whole separate conversation. But anyway, back in the day, before I was in the bowling league, and even while we were bowling in the league, there were other people that weren't, and other younger kids that would have, we call them the bumper pin lanes. And back in the day, these were kind of like a sky blue, almost like an inflatable that they put in the gutters of the bowling alley. And now I think they have, I haven't been to the bowling alley in a while, but I'm pretty sure they have these sort of metal type of rails, I guess, that can kind of pop up on a whim, and then you can take them off if you don't need to use the lane for that purpose. that pretty much also serve as sort of guardrails or bumpers, right? And so if you get up and you're in one of the lanes with the bumper pins, back in the day, the big ass blue inflatable things, and you roll the ball straight down the alley and you hit the pins, awesome, right? You've essentially met or come close to meeting your goal. You've gotten some pins knocked down, you get some points up on the board, good to go. But if you throw the ball and it doesn't exactly go straight down the lane, but instead veers off to the left a little bit or veers off to the right a little bit, we'll have no fear. The guardrail will kind of put the ball back on track, and all of a sudden now, let's say it goes off to the left a little bit and hits that bumper pin, then it kind of bounces back into the middle of the lane, and eventually it hits the pins and everybody is happy. All is well. This approach to the 4% rule is kind of sort of the same thing, right? It's very similar to that. So a lot of times we'll use the bowling alley analogy, and I don't know necessarily that that's something that Guyton came up with, but that's something that it just makes me think back to my childhood and it kind of resonates with me. So I often use that when I'm talking about this type of an approach. And what we do is, and you can set it up any way you want to, but one of the ways that he was setting it up was with ballpark somewhere in the neighborhood of about a 20% plus or minus guardrail. So what does that mean? Well, let's say, before we even get into this, we probably should have started with an example earlier on. If we're talking about the 4% rule, let's say somebody has a $1 million portfolio, okay? They have a $1 million portfolio. The 4% rule basically tells us that we can withdraw $40,000, which is 4% of a million. 4% of 1 million is $40,000 for the year, and that would be our annual spending or a component of our annual spending from that portfolio. And that every year we would take that $40,000 and adjust that number generally upwards for inflation. That's essentially what the 4% rule says. But the other thing we can do, sort of in addition to that, if we want to monitor things as things go on, we can say, all right, well, if $40,000 initially represents 4% of our portfolio, of our $1 million portfolio, we'll go ahead and take that distribution. But the next year, we're going to take a look and see what our portfolio value is at that time. And if we adjust our $40,000 for inflation and we take that number and compare it to our portfolio value 1 year later, depending on now what percentage of that portfolio that number represents, we may have to adjust our spending. So let's kind of go through this with some numbers. Let's say the first year, again, we have $1 million portfolio, 4% is $40,000. We withdraw the $40,000 and that's 4%, okay? The next year, though, let's say that our portfolio is north of $1.3 million, okay? Well, let's take our $40,000 and let's just use the average of about the past 100 years. I know it's much higher here recently, but let's just say we use a long-term inflation average of 3%. So we're going to take our $40,000 that we spent in the previous year and we're going to multiply by 1.03 to adjust the $40,000 for inflation with a 3% inflation factor. So that means that our new distribution is $41,200, okay? But as I mentioned, all of a sudden now, our portfolio, even after we've taken out our first year's distribution, is no longer $1 million. The market went up, and our portfolio, let's call it $1.3 million. So we take that number and we divide by 1.3 million and say, how much does this now represent, this new inflation-adjusted spending number in year number 2? How much does this represent of our overall portfolio? And we do the math. We take that number, divide by 1.3 million, and it turns out that it's a little over 3.16, about 3.17%. Let's just say, for round numbers, that it came out to an even 3%, okay? What does that mean? Well, that means that we're no longer spending 4%. We're spending less than 4%. We're spending, as we rounded down in this hypothetical example, only 3%. So what does that mean? Well, that means we can give ourselves a raise. And that number can be all over the place, but one of the things that Guyton suggests in his research is to give yourself about a 10% raise. So how do we do that? Okay, we're going to take the original 40,000 that we mentioned. We're going to adjust for inflation, so multiply by 1.03 for that 3% inflation number, and we come out with $41,200. That was going to be the inflation-adjusted amount under the original 4% rule. But now, what we're going to do is we're going to increase this number, this new inflation-adjusted number, we're going to increase that dollar amount by 10%. So we're going to take our $41,200 and we're going to multiply by 1.10, which is increasing it by 10%. And congratulations, we now gave ourselves a retirement spending raise, and we're now able to spend in that second year $45,320. So we've given ourselves a 10% raise. That's an example of how that would work. And then the next year, we would evaluate again and make adjustments accordingly. Okay. Now, let's say on the flip side of that, all of a sudden, our portfolio went down. So we had the same $1 million, right? We take out $40,000 in our first year, 4% of $1 million, $40,000. But now, all of a sudden, we had a pretty substantial drop in our portfolio. Let's say our portfolio at the end of that first year, beginning of the second year, is only, say, $800,000. So now the $40,000 no longer represents 4%. Because if we take $40,000 and our portfolio is $800,000, we take $40,000 divided by an $800,000 portfolio, that $40,000 now represents not 4, but it went up and now represents 5% of our portfolio. Because the market went down and our portfolio went down. Well, now we may decide to take a spending cut as opposed to a spending raise. We're going to take a 10% spending cut. So what do? Well, we had $40,000 in year one. We're still going to adjust that by inflation. So we're going to use a 3% long-term inflation factor. So we're going to multiply $40,000 times 1.03. We have $41,200. And now we're going to decrease this dollar amount by 10%. So I'm going to take $41,200, which is going to be our spending in year two, and I'm going to multiply that by 0.9. I'm going to reduce it by 10%, which means in year two, our spending is going to drop to $37,080. That's an example of a spending cut. And again, you can reevaluate in the next year and make adjustments accordingly. You don't necessarily have to do this every year. You could do this every couple of years and make adjustments as you'd like to. But this is one way with the guardrails approach where Guyton would suggest you can actually start, and I believe, I don't have it right in front of me at the moment, but I believe his research at one time said that you could start with closer to about a 5.5% distribution rate. So instead of the 4% rule, Guyton pretty much says, hey, 5.5% rule. However, we need to be able and willing to make adjustments to either ratchet up the spending if things are going well, or potentially ratchet down the spending if things are not going so well. And we can still make those adjustments within reason, but we can start with a higher distribution rate, which means that we don't necessarily have to have quite as much put away for retirement under his methodology. Some people may be okay with that, and they say, yeah, that makes sense. Other people might not. Okay, I actually have a client who is actually using a similar approach to this. He's taking out about a 5.5% distribution rate from an IRA with us, an individual retirement account, happens to be a mutual fund based account that he has. And that account is specifically for discretionary expenses. He already has the rest of his basic living expenses covered with other income sources. And he is using this account for discretionary expenses, meaning that he's using it to go on vacation. He's using it for pretty much fun money, whatever he wants to. And so what we've done is we've talked about the guardrails-based approach, and he is, in his particular case, willing to take temporary spending cuts if needed. And this is something that we evaluate every year, and then we make any adjustments that we might need to make to his spending, whether that's up or down for his discretionary and only his discretionary expenses. Because again, his other basic and essential living expenses are covered by other sources. So that's an example in real life of somebody who is using this in a specific way. And as I mentioned before, this is the way that I personally think that most people should probably consider using this probabilistic based approach. You could still use it for basic living expenses, but again, some of those basic living expenses are going to be very difficult to cut if they're essential expenses if you had cut them. So that's why you want to use this as one component generally of many different components to your retirement income plan. Okay. Now, for those pursuing quote unquote early retirement and those that may not have a 30-year horizon, but perhaps a 40 to 50-year time horizon from the standpoint of quote unquote retired up until when they pass, this 4% rule becomes a little bit harder to implement. And a lot of people will tell you that using closer to a 3.5% distribution rate instead would be prudent. When we do our own personal finances, we have a spreadsheet, which is pretty involved, as you might imagine. And there's several different tabs on it. One of those tabs is what I like to call the financial dashboard. It's kind of a summary tab that you take different other tabs, feed into it, and pretty much you have one page where you can see everything that's of financial importance on that page. And when I update that using sort of this 4% rule methodology, the way that I do it is I'm using it to cover any income gaps from our monthly expenses against other sources first, which probably doesn't make a ton of sense. But one of the things that I personally am doing in our situation is using other types of passive income streams, most of which are going to be from real estate type of investments, not necessarily the stock market, to cover a baseline. And eventually, in due time, as I mentioned on the past several shows about annuities, I will probably implement a certain type of annuity-based strategy when I'm a little bit older and a little bit closer, and I want to sort of solidify some of those streams and use mortality credits to my advantage. In my opinion, that would be the time to do some of those things. But in any case, what I'm looking at now is, okay, what's the expense number? What is the passive income number? And then whatever gap there might be that needs to be filled, I'm looking at a 4% rule type of methodology to cover that gap. And when I do it, again, as being sort of a member of, I guess you could say, the FIRE community, right? Not so much retire early necessarily, although that is part of it, but more so from a financial independence standpoint, I am using personally a 2.5% distribution rate as opposed to a 3.5% distribution rate. In other words, I'm using a 2.5% rule as opposed to a 3.5% rule for somebody that is pursuing quote unquote early retirement. And I do this for a couple of reasons. Number one, just to be ultra conservative. And number two, to allow a buffer against any massive drawdowns, especially because in our case, we're pretty much 100% equities or 100% stocks with our stock market-based investments. I am not a big proponent of fixed income or bonds, especially in light of current conditions in the current environment. I guess we'll talk a little bit about that a little later in the show, but that's probably more so a conversation for another day. But that's the way that I like to look at it, to make it as close to being bulletproof as possible. And again, there's not a 100% certainty of what that's going to look like, but it just gives me an idea, and it also leaves a little bit of a buffer in terms of if I undershoot expenses by a little bit, or if there's certain types of passive income that, although resilience may not come in at 100% of expectations, it may come in a little bit shy from time to time. There's enough of a buffer built in there so that the whole picture still works in tandem. And so another thing or item of consideration is that for those such as us that are using a very heavy equity allocation, is that having, and this is a widely debated topic, but having a cash buffer, and everyone's going to define that differently, but most generally about 1 to 2 years of expenses, could actually help in a situation like that where you don't necessarily have a large or any allocation to fixed income and you're basically 100% equities. That barbell type of approach, right? You got some cash on one end of the barbell and you got some equities on the other end of the barbell, and there's really not any fixed income to speak of in the middle of the barbell. That can actually help in that situation. Most people are not 100% equities or anywhere close to it. Most people are going to be more towards the moderate end of the spectrum, as we talked about and as the research initially came out with, sort of that 60-40 type of allocation. And some people might be 50-50 and some people might be 75-25 and so on and so forth. But they're going to be more of a moderate type of portfolio for those that have a more balanced portfolio, which includes fixed income and bonds. A cash buffer, on the other hand, can actually hurt those people because in most market environments, bonds are already or supposed to be already doing their job of somewhat stabilizing the portfolio under the majority of market conditions. It's not going to work 100% of the time, but they're already in there for a reason, and therefore having cash on top of that further detracts from the overall ability for the portfolio to be optimal and do what it needs to do. So to sum up the previous few minutes in English, I'm super conservative and I use the 2.5% rule on top of the real estate when I do my planning for us. If you're super aggressive with your investments, a cash buffer can help you. If you're more of a moderate investor with your cash investments, because you have bonds, cash, and an excess amount of cash, having 1 to 2 years or so of expenses covered in cash can actually hurt you. That's basically what we're trying to say here. So you might be wondering, well, does the 4% rule still work today? And the short answer is maybe, right? Maybe. Some additional factors to think about are going to be varying retirement starting ages, depending on when you may want to retire. Another factor is going to be increasing life expectancies. Generally speaking, people are living longer and longer. Also, higher recent and possibly continued inflation, which for all intents and purposes is pretty much part of and already factored into the history of the 4% rule, but that is something that's of concern to people today. Lower interest rate environment that we're in and lower interest rates that we've had in recent years, which therefore leads to lower recent bond yields. When this study was done, a lot of the time periods that were evaluated, interest rates were a lot higher, bond yields may have been a lot higher, inflation in some cases may have been a little bit lower or quite a bit lower. So there's a lot of different moving parts that are going on here. And even though we've had a 20-ish, give or take, a little bit of a market drop or pullback recently here in 2022, if you look at current stock market valuations, even in light of that, you could say that things are a little bit rich or things are a little bit expensive right now. And so those are some other things that you may want to keep in mind. I don't think any of them in isolation are going to be deal breakers, but when you put all of them together, there are some things there to think about. Some other things to mention or some other considerations. This one I thought was pretty interesting. According to a relatively recent podcast interview that I heard Bill Bengen on, he mentioned rebalancing frequency could potentially make a difference. And he mentioned that a little bit longer, I think 3 years was mentioned, was supposedly better than an annual or quarterly rebalance. I've not seen enough other external research out there to substantiate whether or not that's actually the case, but I think the takeaway from that would be don't feel like you have to optimize your portfolio every second of every day. It's okay to let things run for a little bit, essentially, would be a takeaway there. The other thing that's oftentimes not mentioned or talked about and certainly not considered, especially in the original research, is any legacy needs that there might be for a particular client. So the 4% rule is not historically focused on this. So if you have some legacy needs that are desired, you want to leave some money behind, whether that's to children, grandchildren, charity, whatever the case might be, you may want to decrease your distribution rate or the percentage that you're withdrawing from your portfolio to be able to make sure that, absent any other planning, like life insurance, for example, that you have something potentially to leave behind and you're not spending the account down to zero. Remember, the 4% rule is pretty much designed to say, how much can we spend safely, even if shit hits the fan, and not go broke? It's not designed to say, how much can we spend safely and make sure we leave $1 gajillion behind, right? Those are not conflicting goals, but they're not exactly both factored in together. So if your plan is to leave behind $500,000, $5 million, $50 million, whatever the number is, keep in mind that the 4% rule does not consider that as part of the plan. So you want to make sure that you have a plan for that, whether it's to potentially reduce your distribution rate, or as I mentioned, have life insurance as part of your plan. Another thing to mention is that the 4% rule does not include any other income sources that might be able to be used to round out your overall retirement income. So again, whether you have Social Security retirement benefits, or whether you have a pension, or in some cases, certain people might want to consider rental income, or annuity income if you have other annuities. Whatever the case is, none of that is considered with the 4% rule. So keep in mind that there are likely going to be other income sources to round out your overall retirement income plan. As we, I think, mentioned, the ability to reduce certain discretionary expenses as opposed to having static spending. So if you're using this to cover all spending and you have zero flexibility, you want to make sure, first of all, I wouldn't recommend doing that, but you want to make sure that you're using either the guardrails type of approach or your calculations are fairly conservative, because if you don't have a lot of room for flexibility, you may find yourself in a little bit of trouble. So we talked about the guardrails. The other thing is the ability and willingness to do other things to generate income in quote unquote retirement. And this, I think, especially holds true for the quote unquote early retirement people. Most of them are going to either have a business or some sort of a side hustle, or some people call it the gig economy. You're probably going to be doing something that's somewhat productive, even if you're doing it on your own time and your own terms. And more than likely, that something may turn around and generate some income. So it's not like you're never going to earn another dime again. But again, the 4% rule assumes that. 4% rule pretty much assumes that, like, hey, that's it. Here's my nest egg. Here's my portfolio. Here's what I have. And I'm going to have to take distributions from it with some sort of sustainable withdrawal strategy. What are my options? It does not assume that you're going to continue to generate income. And in a lot of cases, especially for early retirees, quote unquote, you may just do that. You may actually be generating additional income, which again gives you a little bit of a buffer on this 4% rule. There are different approaches, as I've mentioned, probably through several different podcast episodes now, to retirement income, right? There's different types of allocation strategies. And I thought about doing a separate episode on this, and I really don't think a podcast would do it justice because there is so much nuance and so many different variables that come into play for an individual. But I'll mention a few of them here just really briefly. One of them that's fairly popular out there is some sort of a bucket strategy. So you might have a short-term bucket, and a lot of people, it's going to be cash or cash equivalents to fund short-term needs. And I've seen anywhere from 1 to 5 years worth of expenses for people there. I don't think that's, in most cases, the optimal way to do that, but there are people that will do that. They'll have a short-term sort of cash bucket. They'll have a mid-term type of bucket where it's predominantly going to be bonds or fixed income that funds that. And then they'll have a long-term bucket, primarily, which is going to be consisting of stocks or equities in that long-term bucket. And they draw and shift funds across those 3 buckets accordingly. There's a lot of considerations there. What account types are you using? From a tax optimization standpoint, you have to be careful about holding certain types of investments in certain types of accounts, also known as asset location, as opposed to just asset allocation. There's a lot of different things to be thinking about there, but one approach to retirement income planning might be some sort of a bucket strategy. Another one would be to use annuities for basic living expenses and maybe couple that with things like pensions and or Social Security for those basic living expenses. And that a lot of times will allow for a more aggressive discretionary allocation where you might be able to implement the 4% rule or some variation of that for those discretionary expenses. So that would be sort of a, basic, creating an income floor is what a lot of people like to call it. You're creating a retirement income floor with certain types of quote unquote guaranteed sources like annuities or pensions or Social Security and so on and so forth to cover those essential expenses. And then building on top of that, for anything discretionary, you may use a different approach, right? So that sort of be like the income floor type of approach. And then other people say, you know what? Fuck annuities. I don't want anything to do with annuities. I listened to all the episodes. I've done my own research. I've gotten educated, and that's just not something I'm interested in. I'm not willing to pay the fees, even though I understand the flexibility and the value that some of those contracts can provide. I don't think I need to do that. Okay, well, you might use something different. You might use sort of a bond tent structure, right? As you enter what some people call the retirement red zone, which would be plus or minus 5 or 10 years before retirement, plus or minus 5 or 10 years after retirement. You kind of bracket the time frame around that, and you may choose to use a higher fixed income or bond allocation immediately before and then immediately after retirement to sort of protect that retirement red zone, and then move back to a more balanced allocation over time, because the years immediately before and immediately following retirement are generally the times that you're most financially fragile. And if we have a sharp downturn in the markets, that can in some cases really derail somebody's plan. Although again, the 4% rule accounts for that. So that's kind of baked into the calculation and baked into the numbers. But some people may not want to use annuities, and they might want to do something like that. Although again, I think in today's environment, especially where interest rates are, you need to be very careful of doing that. And the question would be, is that really feasible in today's world? And is that really as quote unquote safe as you otherwise might think it would be? It may not actually be as safe as you would generally think, especially in light of the conditions that we see ourselves in today. So I do think annuities can play a role in mitigating what we like to call sequence of return risk and kind of filling in some gaps in the retirement income plan. Like I said, building an income floor maybe with annuities, use a 4% rule type of approach for discretionary, or that probabilistic type of approach for discretionary needs. I think that this makes some people very comfortable, right? Again, other people hate annuities and would rather strictly use a 4% rule type of approach or a bond ladder type of approach, and they understand the risks of doing that and they're comfortable with that. Have at it. No big deal. It's whatever works for the individual, right? And also, final thing I'll say here is that you want to consider different sources of income, whether that's business income, royalty income, rental income, annuity income, 4% rule income. There's so many different ways to do this. There's no one right or wrong approach. I think you need to figure out first what you're trying to do, second, where your risk tolerance and comfort level is, and then finally start to piece together a plan that's ultimately going to get you to where that goal is. And again, personally, I would probably do a hybrid combination of all of this stuff, right? I want real estate and residual income from real estate investments to be a big component of this. Social Security, even though we can do a whole separate show on that and the solvency and everything else, I do think that that's going to be there at least to some degree in the future for those that are here in the U.S. And so that can also be a portion of your plan. And even if it's not, I think you can use sort of private annuity contracts to build out that income floor. And then I think on top of that, for any sort of discretionary type of expenses to some degree, you can use a 4% rule type of probabilistic approach. I think you can literally stack almost every type of component on top of each other to really create a comprehensive plan that's going to work in your situation. So you got to figure out what works for you. As I've mentioned before on the show, and we'll say it again here because we've gone a while without saying it so far today, we don't give any tax, legal, financial, or any other advice on the show. Please consult your own professional for any individualized advice. We provide education, entertainment, ideas, information. It's up to you to do your own due diligence and consult with your own team before you make any financial decision. So that's our disclaimer for the day. So a couple final things here. Number one, what's Bengen saying today? What's good old Bill Bengen saying today? Well, there recently was an article that quoted him at the beginning of the year talking about, I think it says, quote, the January 1st, 2022 retiree is retiring under conditions which have no certain precedent in the historical records I have used for my research, ... And then he went on to say that, quote, we may witness history being made and the first decline in the, quote, safe withdrawal rate in more than 50 years. So that's coming from the guy that pretty much came up with this fucking thing, right? Like, oh my gosh, shit hit the fan and we may have to reduce the number. Well, maybe, maybe not. And if you remember back to the annuity mini-series, for those of you that listened to the annuity mini-series, and if you did, check out the pizza challenge because we still need to do that drawing. So if you want a shot at some free pizza, send an email to realtalkpersonalfinance@gmail.com with a screenshot of a 5-star review that you've left for the podcast and put your favorite type of pizza in the subject line and we'll get you entered in. But those annuity episodes went through different ways that annuities can be used, and we talked about payout rates. We also talked about distribution rates, which essentially, for all intents and purposes, are virtually the same thing. And so if you think about that, and then you think about the 4% rule, you can kind of see how a lot of this stuff plays together, right? You have a product or a contract, for example, that says, all right, we're going to let you take out 6 plus 7, in some cases plus %. And as long as there's an account value and things go well, and you can do that for as long as you have money in that account. But if it ever goes to 0, it's going to drop. And it might drop down to 4 something or 4. It might drop down to 3 something or 3, depending on the contract and the rider and all the stuff that we talked about on previous episodes. You can see and kind of draw some parallels between those payout and distribution rates versus what we're talking about in light of the 4% rule. The 4% rule doesn't really require any fancy riders. It doesn't require any extra fees. It doesn't require any specific surrender charge period or contract or anything like that. But what it also doesn't have is a guarantee attached to it, right? But a lot of these contracts out there, depending on how you structure them, they can have a lot of those guarantees. And most of the time you are going to pay an additional fee and you are going to be subject to some type of a time commitment or surrender charge period. And there are some cons to that, but it comes with the pretty much guarantee subject to the claims paying ability of the insurance company that the income stream is going to be there. And some people don't want to pay the extra fee and they want to roll the dice. All right, cool. 4% roll to your face. Other people don't really give a shit about the fee. They want the guarantees and they want to have the warm and fuzzies and be able to sleep at night. All right, maybe you consider an annuity for a portion of your retirement income plan. There's no right or wrong answer. Like I said, personally, I would do both if it were me. So you got to figure out what works for you. But anyway, what is Bengen actually doing today? Well, supposedly violating his own rules, believe it or not. According to an article in April of this year, 2022, his recent allocation is now 20% equities or stocks, 10% bonds or fixed income, and 70% cash, to which my immediate reaction was, what the fuck? This is coming from the guy that supposedly created the 4% rule, right? So apparently, he's not grabbing his nuts.
These nuts? Got him! Got him!
Like Cube Crusher talks about, and stay an investor for the long term. Apparently, he's doing something completely different. And I think it's interesting that he mentioned on a recent podcast, I think it was November of 2020, that he's not very knowledgeable in the real estate area, or at least he wasn't when he was advising his clients before he retired. But I often wonder, how might his allocations be different? Or how likely is it that he would have been able to remain invested if he actually had some real estate investments or other assets? And I don't know what his exact balance sheet is, and this isn't a shot at him or anything like that. It's just an observation that I think there's some real merit to having investments both in and outside of the stock market, especially when there's not always a direct correlation between stock market-based investments and other types of investments. And sometimes there is a little bit of a correlation, but it's not exactly a one-to-one direct correlation. I think there's some merit to that. And so when people oftentimes will ask or say things about their portfolio, or should I go to this portfolio or that portfolio, if you're evaluating your situation over time, or you've had some major financial changes, or all of a sudden your time frame for the funds or goal for the money has changed, maybe that warrants a change to the portfolio. But I find that there's far too many people, far too often, that are looking to make a change in a portfolio simply as a knee-jerk reaction to what's happening in recent times in the market. And my response to that is that the right portfolio, as I probably said on previous shows, for that individual is the one that they can remain invested in. Doesn't mean it never changes periodically. It just means that you should not be in portfolio A that's super aggressive, and then 30 days later or however long later you're in portfolio B that's super conservative just because the market dropped 20%. Because it turns out that more than likely, based on your risk tolerance, portfolio A of being very aggressive was never the right portfolio for you in the first place, right? So that's just another observation. But I guess the point is, having other assets, potentially non-correlated assets, or at least assets that are not directly correlated, could potentially help people to remain in their allocations throughout extended periods of time. So, wrap out and round out the show, what's the cash flow king think about all this? Well, I kind of gave you my perspective throughout today's show, but I think it is important to determine, an approach to retirement income planning and know yourself as an investor, as a person, and just to be in tune with your emotions in different market cycles. I think for those that are able and willing to make adjustments to their spending, and those that have a higher risk tolerance, that it's possible to have the 4% rule, or sort of this probability-based approach, as the main component of their retirement income plan. For those out there that are not able or willing to make adjustments to their spending, and or those that have a lower risk tolerance or just a higher desire, which is kind of where I fall in, a higher desire for a level of certainty for basic living expenses being covered, then I think it likely makes more sense to have an income floor type of approach with annuities, depending on which type may resonate with you, as a major component of your retirement income plan. So with both of the things I just mentioned, I think it's also important to look at other sources of retirement income as the baseline of your distribution strategy, as well as, like I said, things like Social Security, pensions, rentals, possibly, and so on, and kind of build it out from there. So I don't think that there's a right or a wrong answer. I think it's a very personal decision. As we've said before, and many others have said, personal finance is personal. I think you need to do what works best for you. And again, not to sound like a broken record, but you really should be consulting with, in my opinion, a professional to help you build out your plan if that's something that you desire. And there's going to be some of you out there that are kind of the do-it-yourself crowd, and that's cool too. Just make sure you're looking at all the angles. So I don't think it's all annuities versus all 4% rule versus all this or all that. I think you really need to assess and look at what do you have going on in your personal life, what's on your personal balance sheet, what does your personal income statement look like, what's going to change over time, what are your goals, what is your time frame, and start to piece that together in light of all that information to come up with what works the best for you. For those that may be a long way away from retirement, or maybe you're not quite sure, or you just want to have some sort of target to shoot for, and you just want to say, hey, look, here's what I spend. You go back to that Akamal couple that I talked about from the vacation. You take your expenses, in their case was $6,000 a month, so $72,000 a year. All right, cool. Multiply by 25 or divide by 0.04. The math is the same. 1.8 million. For them, that would be the target using the 4% rule. That also, like I said, assumes that they have no other income sources. That assumes that, under the original research, retire at 65, live until 95. And also keep in mind, there's no consideration given in that particular instance for the type of account that those assets might be in, right? There's no edit there, if you will, for taxes. So in the example of a $1 million portfolio, I think most people would assume, well, that's $1 million in a 401k or similar type of plan. It's tax deferred and it's pre-tax. So when the $40,000 or 4% of $1 million, when that comes out, you more than likely still have to pay taxes on that, right? So you need to consider things like that to get to your net number. There's a whole host of other things. We don't have time to get into all that right now. Bottom line is, if you want a back of the napkin number, use the 4% rule. And you'll find out when you run some of these back of the napkin ballpark, having a drink at the bar type of calculations, reducing your expenses even by a particular amount, a very small amount, can have a fairly large impact on the number that you may need to have put away in order to quote unquote retire. And with that said, last thing I'll mention is you want to keep in mind things like, for example, well, maybe you have a mortgage now, and if you listen to the Power of Your Mortgage show, maybe you'll always have one. But let's say for a lot of people, for emotional and psychological reasons, by the time they retire, they don't have a mortgage anymore. And so when they're planning for retirement, they may have a mortgage of X number of dollars per month, right? But when they're retired, that principal and interest component is likely not going to be there. So when they're doing their 4% rule calculations, it may make sense in that instance to factor that in and reduce the expense number by the amount of the principal and interest payment on the mortgage if it's not going to be there in retirement, right? That would be one adjustment. What about some other ones? What about healthcare costs? Do you need to add that in? Do you need to add that in with a different inflation factor? Do you need to add that in with an inflation factor that's higher than general inflation? Because typically healthcare related expenses increase at a rate faster than other expenses, all else being equal, right? And that's where when you really get into this and you really dig deeper and you get into the different nuances and intricacies of this retirement income planning process, you really need to be using, in my opinion, financial software that allows you to accurately and quantifiably model this stuff, which is why I always say that you might want to consider working with a professional that has the tools and ability to be able to do that for you. And if you can find a way to do that on your own, or you're really handy with Excel, or you can find some software out there for purchase or lease that you want to use and you're comfortable doing that on your own, that's fine. But I think it's really foolish, and I can't tell you the number of people that do this where it's kind of a guessing game for them. Well, my expenses are this and Social Security is that. And so, Social Security is more than my expenses, and I got a little bit of money put aside in case that's not enough. Yeah, we're fine, right? We don't need to do a plan. Heard that a million times. Money well spent, folks. Money well spent, especially if you find somebody that is licensed and credentialed and has the ability, the tools, the software, and the capability to help you out. I really think that you should consider that. There's a lot of people out there that do that. We don't sell anything on the show, so this is not a plug for us in any way, but I really do think that you want to look for somebody that can help you and has experience in that area. So with that said, that is today's show, episode 20 on the 4% rule. Thank you for taking the time to tune in. Please feel free to share the show with a friend or family member. Please also feel free to leave a 5-star review if you feel like we've earned it. We appreciate it. And don't forget the pizza challenge. That's all I got for you today. We will see you in the next episode.
Check the mic and make sure it sound right, boys.